Good evening, ladies and gentlemen. This is Barry Norman on behalf of investing.com, and welcome to our webinar, 6 Incredible Chart Patterns. And tonight's webinar is sponsored by investing.com, and welcome, and we're going to get started right now. Now, tonight's class is being recorded. You will receive an email automatically from investing.com with the link to the webinar when it is prepared and ready. Okay, so it will automatically come to you at the email address that you registered for the class tonight. There's no need to call anybody, contact anybody, or anything else. When it is prepared, it will be shared with you. Now, tonight's class is all about chart patterns. Chart patterns are visual images that we see in charts based on previous patterns that we have been able to apply and see happening over and over, that we've actually been able to define these actions. And they're really based on the mass psychology of the markets. Now, technical analysis refers to the study of the financial markets based on price movements. It uses the assumption that price is a share of a share or an asset reflects all the information about that share, including market sentiment as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in prices. For example, heads and shoulders, which is one of the most popular patterns that traders look for, or channels, or triangles, wedges, and these are repetitive patterns that appear over and over again, and once they have developed these patterns, we can then evaluate what the markets will be doing or what the psychology of the markets will be doing. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of future trend of a price when it breaks key psychological barriers to form support and resistance lines. So chart patterns are not a trading system. They are alerting you to price action. Now, there are numerous types of patterns, all named according to the shape that the price graph form between the support and the resistance lines. The general types of patterns include triangles, channels, wedges, and heads and shoulders. Now, under triangles, we have 3 different types. Now, you don't have to remember the names. When you start trading, you're going to find there's lots of names, whether you're trading using candlesticks, and there's lots and lots of patterns involving candlesticks, or you're using other types of technical indicators that all have weird names, or chart patterns. As long as you recognize the pattern and what it's telling you, what the name is really unimportant. So, but we have 3 basic types of triangles. This is called the symmetrical, the ascending, and the descending. Now, a triangle is formed between converging support and resistance lines. And if you're not sure what support and resistance are, we have whole classes in just understanding support and resistance. But a negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of an asset. With a positive sloping support line, the price levels are squeezed into a corner. So what happens is, as price is moving, they are pushed into this corner between the support line and the resistance line of the price. And when they get forced into this little corner, the traders are forced to act. The reaction that the traders have then becomes predictable because it's going to indicate whether it's the bulls or the bears controlling the market. But as they get forced into the center of the triangle, they are forced to act. And based on the shape of the triangle, you can predict price movement. Now, once the support and resistance line is broken, pressure that is built up as a result of the uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. So if the price breaks out of the channel going down, that's where the momentum is. If the price breaks out of the triangle going up, that is where the momentum is. If it breaks out down. Now, there's whole entire trading systems based on what's called breakouts. Now, I just got to get my marker back up here. Okay. Now, to identify these patterns, there are specific variations of triangles that occur. Now, namely the ascending and the descending triangles. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. Now remember, support is what's holding up the price. Resistance is what is the price has to break through. Now, again, if you're not sure about support and resistance, imagine an elevator. When an elevator is moving up, the floor is supporting your body, and you're being pushed up through each ceiling to get to the next floor level. So the ceiling is your resistance, and the floor below you is supporting your feet is your support. If the elevator is moving down instead of up, it is just the reverse. So when we're looking at the ascending triangle on the right side, we see price moving up, and this would be the support line. It's actually supporting the price movement. This is the resistance line because every time it hits this price, it bounces off of there. So the price has a resistance. It's having a difficult time breaking through that level. And this helps us form the triangle. The triangle is formed by attaching together a trend line, but not a price trend line. It is using the swing lows and drawing a line out, and here we're using the swing highs and drawing a line forward. So we've got our resistance line here and our uptrending or support line here, and this is pushing price into this triangle. In a descending triangle, we have price moving down, and the support line is underneath, or the resistance line, which is actually the support line, the resistance line, because when price is moving down, it's trying to break through this level, and every time it hits that level, it breaks off, and our support level is above here, pushing again price into this inner corner. So an ascending triangle usually occurs as a continuation of a bullish trend. That means an uptrend, where a descending triangle usually occurs as a continuation of a bearish trend. Uh-oh, sorry about this, I lost. There we go. Okay, using triangles to trade. It's important to note that an ascending triangle can be found in a downtrend. Okay, it's rare, but it can happen. So the combination of the name of the triangle and the market trend is deceiving. Thus, the financial asset needs to test the resistance level twice, and the asset closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. Now, the closing price is not the day closing price like in a stock. It is the closing time of the time period. If you're looking at a 15-minute chart, it's the end of the 15-minute time segment. If you're looking at a 1-hour chart, it is the candles or the price of bar charts that are put on at each 1 hour. Next, we come to volume. When in an ascending triangle, volume usually contracts. So when price is moving up and we see a contraction in price, or a contraction in volume, now volume should move with the trend. If the trend is steadily moving up and volume is staying steady with it, it's supporting the trend. If we come and we see volume contracts, volume getting less, okay, then it's giving us, these are the rules that make the triangle work. So it's not just putting lines on a chart and saying, oh, look at that, it looks like a triangle. There are rules that have to go with it. Okay. So when in an ascending triangle, volume contracts. Although there are a few numbers of cases that show volume has not contracted, but the pattern has been displayed. This has been signified by the blue line at the bottom of the chart. So when you see volume, it appears on the bottom of your charts. And when you're using your real charts, you can just click on the indicator that says volume and it'll drop it across in the blue lines. Now, to help you decide to trade when it fits these rules, there is a correlation between the width of the triangle and the price movement you could expect. So the distance between the rising trend line and the resistance line gives us our projection. So in other words, when you measure the distance of the support line and resistance line forming the triangle from the point they began, when you have your breakout should give it the momentum to carry it an equal distance. So if you're looking at a price chart and say gold was down here was at 1250, gold up here was at 1220, 1255, that's a 5-point price spread. When you have your breakout, you should expect your breakout to give you 5-point price movement going in that direction. Okay, I'm just having a problem getting my markers off and on here tonight. There we go. Then we also have patterns called channels and rectangles. A channel is formed between parallel support and resistance lines. The pattern usually indicates a relatively strong trend up and down with the price staying within the lines until the breakout. So a channel, again, you're drawing these appropriate trend lines based on swing highs and swing lows. And when you put the two of them together and project your line out forward, you can either get a channel, a rectangle, a triangle, okay? And if one of these patterns exists or develops, you can then indicate what it's from. Or you can then determine what the rules are and see if you can trade from it. So again, with rectangles and channels, we have the same breakout and the same direction of momentum. So similar to a channel, a rectangle is a pattern formed between horizontal support and resistance lines. So in other words, here we saw a price moving up. We connected two swing lows and pushed our line out into the future. We connected two swing highs and projected our line out into the future. And what did we get? We got a channel up. Here we did the same thing. And we have a channel down. Okay. So this becomes your support and your resistance lines, your top and your bottom. And in this case, it formed a triangle. When you put it on the chart, it could have formed a rectangle, or it could have formed a triangle. Okay, so these are the patterns that you will see appearing on your chart when you properly put these pattern lines on your chart. Remember, the line is drawn from your swing low connecting other swing lows and your swing high connecting other swing highs. Now, if you're not sure what a swing high and a swing low is, it's the lowest price or the highest price that asset touched in that trading period. So you cannot decide, oh, I'm going to draw it from here to here to here. You must incorporate the swing highs. Okay? And no matter what you do, if you would have started here, and then you have to incorporate the swing lows, and it can't, the support lines can't have been violated. So it's not going to form. If you try to fudge the rules, it's not going to work. And it doesn't matter what time frame you're using. because it's going to form the pattern. If you see the pattern in that 1 hour time frame or a 15-minute, now you're not going to try to force the trade by adjusting your charts. If you're trading on a 1 hour chart, you see this developing because your strategy or the type of trade you're making, because the type of chart you're using ties to the type of trade you're looking to make. So you're not going to go back adjusting your charts from a 1 minute chart to a 5 minute chart to a 15-minute chart, trying to find a channel or a pattern. You're going to locate that pattern within your rules of your trade. Okay. If you're building your technical analysis and you're looking at your chart in a 15-minute chart, that's where you're going to be looking for your triangle. It's not a matter that it's better or worse in a 15-minute to a 1 hour to a 2 hour. It is all based on your style of trading and what your rules are for your technical analysis. So if you're trading in short-term trading or day trading, you want to use a shorter-term time frame. If you're a swing trader, you want to use a longer term or say a 1 hour chart. Okay. If you're looking for longer-term investments, you want to look at multiples. Or you can have a 15-minute chart and a 1 hour chart and look at different patterns on different charts, because what you're looking for is clues to what an asset's going to do. But you're not trying to fudge something just so that you can get a pattern. Now, rectangles and triangles are sometimes referred to as flags and pennants. You'll often hear them used as flags and pennants. I don't use the term flags and pennants at all because it's kind of confusing, and they really don't look like either. So a channel or a rectangle is pretty easy to notice. Okay, whether you call this a flag or a pennant, I don't care. I don't know. Okay. Now, is it a channel? Yes. And you see, again, you have your swing highs and your swing lows connected. Then we go to wedges. So remember, we have 6 different chart patterns we're looking at. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. However, where the support and resistance lines in a triangle have one positive and one negative slope, the support and resistance lines of a wedge would both have either a positive or a negative slope. So in other words, a triangle should usually have a base and price moving into the base. Okay. Or you would have, so a triangle would be like that, or a triangle would be like that. So in a triangle, one of the base is usually a horizontal line. All the differences between a triangle and a wedge is when both lines are sloping, and even though they're forming in together, instead of this being an ascending triangle, what is it? It's a wedge. Okay, it's a continuation wedge because it's still forming the triangle, but it's forming a wedge because both of the lines are converging together. You don't have a horizontal line as the top or the bottom. So if you want, let's go back and look at triangles again, and we'll try to see the difference real quickly. See, so a triangle has a base that's, let's get my marker back on here, that's horizontal. So in a descending triangle, you have your resistance line, and then you have your support line coming down to meet it. In this case, and they don't have to be perfectly 100% 90-degree angles. Okay? But in this case, you have your baseline here and your upswing of your support line underneath of it here, forming a triangle. Whereas in a wedge, now what we're calling here as a standard triangle, not an ascending or descending, could be considered a wedge. Okay, very, very easily, because it's only the difference between the movement of the lines forming the triangle. So going up, you have what's called a continuation wedge, and a continuation wedge is very similar to an ascending triangle. You have a wedge reversal or reversal wedge, which is very similar to a descending triangle. The most common wedges are found as breakouts in the opposite direction of the wedge. That is bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. So what happens basically between a wedge and a triangle is the market reacts differently. In a descending triangle, you're expecting the breakout to break out down below, where in a wedge, you're expecting it to move in the opposite direction or break out moving in the opposite direction. Okay. Then we go to one of the most well-known and most talked about patterns. And this is because it's got a cute name. And it's called head and shoulders. Now, a head and shoulders has specific rules to it. A head and shoulders pattern describes a price movement that depicts the heads and shoulders of a person. Okay. Now, we have an inverse, which is just the exact opposite of a head and shoulders. Okay. You have in a head and shoulders, this is called the neckline right here, which is the baseline. Okay. What you have is you have price movement up, price peaks up, and then falls back down and comes to what is establishing as the neckline. Price then moves up, but it moves higher than the peak before, and when it comes back down, we will expect price to form that right-hand shoulder, and that right-hand shoulder should be equal to the left-hand shoulder, and if that happens, we would then expect price to break down and come downward. Now, there are formulas, and we're going to talk about these in a second, to understand how the distance should be measured and how these will give you trading clues. So an inverse triangle is an inverse head and shoulders is the exact opposite. So this is called the neckline, this is called the shoulder line, and of course this is called the headline. Okay. And it happens actually quite often. It's a very, very common pattern. And now it does tell you, it is based on the psychology of the markets. Now, the popular head and shoulders pattern is essentially a triple top pattern, except that instead of all the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the bearish fallback that occurs between the tops, with some allowing for a 10% loss before the price returns to test the resistance level, while some require 15%. Regardless of opposing views, these patterns are very popular among traders and analysts as they tend to predict price reversal or trend reversal with relative reliability. Signal strength is bolstered by the agreement from both indicators, such as waning volume as the trend nears exhaustion. Now, an inverse head and shoulders is just the opposite. Now, the way we work with the head and shoulders is like I explained. The price that the price breaks up forms the left shoulder. Where it comes down and bounces off of is defined as the neckline. We would expect then price to move up higher than the formation of the left shoulder and come back down to the neckline again and then form the right shoulder. Okay. Now we can see in this case the right shoulder is higher than the left shoulder, so you're a lopsided person. But then you expect price to come back down to form that final shoulder. Okay. So there is a formula that will help predict a target price so that you can expect where price will go to. Okay. So the target price is T, which is target, equals N, which is the neckline, minus the head, minus the neck. So if hypothetically this was a 1, this was at a 2 price, say this was $1, this is $2, and this is $3, we don't know what the target is, but we do know is that the neckline was at 2, minus the head, which was at 3, minus the neck, which was at 2. So what do we got? Is 2 minus 3 minus 2, or 1 minus 1. 2 minus 1 equals 1. And what is our target price? Our target price would then be 1. Now, it could fall way below there, but you're going to expect some market action. So if it breaks here, this would give you a sell signal when it formed that right shoulder and hit the neckline, and you would set your target to be down here at the 1 price. Okay, you don't care that it's going to go farther. You want to know where to set your target for your trade. Okay. And this is the formula that you would apply to set that target. So when you have the third part of a documented head and shoulders, and you form the right shoulder and price then starts moving down, it comes down to that neckline, you should be ready to enter a trade or a sell signal to sell that asset to come down to your target price. Now, you can get more involved in this as you learn them, because you can also use these as to where to put your stop loss and where to put your take profit. But your stop loss could be set at the height of the left shoulder. So you would set your stop loss here and your take profit point here, and this is where you would allow your trade to come to. Okay. Inverse head and shoulders is exactly the same, but the opposite. Now we have what's called multiple tops and multiple bottoms, okay, where it's triple tops or double tops. And these are pretty straightforward. Okay. It's when price is moving up and the price moves up and you're able to draw your support line and your resistance line. It tops out and hits your resistance line, bounces back down to your support line, bounces back up to your resistance line, bounces down. You can expect it to then break out of your double top. Or you have your double bottom. When price is moving down, it comes down to that resistance line, so back up the support line, back down, and it forms either a W or an M, or you can say an upside down W. So double top is a recurring pattern that happens quite often. Triple is a very strong trade signal. Okay. Again, double tops are measured the same way as you would measure your head and shoulders. When you have a double top, and you can see when we have them on a sketch, they look clean and nice, but when you're actually looking at how they're trading, excuse me, you have to see them form. So again, we have price moving up. Price had come off a downtrend, was moving back up. We saw it break the support level. It went to form the resistance level, and see, you can actually drop a straight edge on here across the swing highs to form your resistance level, and it bounces off there, comes back down to your support level, which your support level were these swing lows right here, and bounces off it and moves back up to that resistance level, and then comes back down and breaks that support level, and this generates a sell signal, and you would then set your target, and your target would then be, again, support minus height of the pattern. So your height is the difference between this distance. So if your support level is here, and say, again, it was say at $1, and your resistance level was at $2, when it breaks through and coming down, you would set your target by taking, your target would be your support level, which is 1, minus your top level, which was at 2. So your support level, your target level is -1, and this would be here. Now, double tops and double bottoms are very, very common. Most traders notice them, but they don't trade from them because they do occur so often. But a triple top and a triple bottom become very rare. They are very rare happenings when you can actually see them truly develop. So when they do, they are very strong indicators. Okay? And they're much stronger than the double top and the double bottom. So it's the exact same action, except they've now moved in, hit support, bounced off to resistance, bounced off again, and then they've supported. What happens is that the traders are saying that these two key levels are very, very, very important. Okay. Therefore, the asset moving up was not able to break above whatever this level was. The bears just weren't able, the bulls just weren't able to push it. So the bears pulled it back down. This is when the bulls got back to in the market. And this is the ongoing tug of war. And these numbers, when you see them on a chart, you can see that they are strategically and historically important to that price in that time segment you're looking at. So if you're looking at a 15-minute chart, this could be over the last few hours. So the bulls and the bears could be fighting over the euro 108.52 today. This is where the euro is. But if you're looking to trade the euro in a more long term, and you're looking at a month-long chart, you would again see that these numbers, but it would be different numbers because you would see the tops and the bottoms at different levels then. So you have to look for them, but look for a strong initial trend and a significant breakout in order to confirm a reversal. So again, when it breaks this support line, it's going to have the momentum in that direction. And this will confirm a reversal. If it bounces back up and breaks out upward, that's a continuation pattern, and it's going to continue in its uptrend. So you have to determine whether it's a breakout or a reversal. Okay. Now, a triple top, again, it's very pretty to see it on here, but when you're looking at actual trading, it's a lot more complicated to see it. And you see this by drawing your support line and your resistance line based on the swing highs, but where there's been congestion in price. Okay. And that's what's very important about, not about finding support and resistance levels as opposed to the support and resistance channels when we looked at channels and triangles. Channels and triangles form those lines because they have to form the angle lines. When you're looking at support and resistance levels, these are the price where prices have had a historical problem of breaking through. It isn't the swing high or the swing low. Those are used in other respects. These are where the price is congested. Okay. These are the peaks and the valleys as price is moving, where the buyers and sellers have had a difficult time moving that price. And you can see the commonality. You can see how many times this resistance was hit by that price. Same thing with the support. How many times in that price movement was that number extremely important? Now, once you have these on your charts, okay, you see the price moved up, broke out of this mess here, moved up, came up to the new top, was not able to break through that top support to top resistance line, came back down towards the support line, moved back up towards that resistance line, came back down toward that support line, and again bounced off. So the bulls and the bears were fighting back and forth, back and forth. At some point, either the bulls or the bears could win. Okay. Now, when the price breaks out down below the support line, the bears have taken dominance in the market. Okay. Now, how would you calculate your target level? Okay. Your target would be T for target equals support minus the height of the movement between the support and the resistance. Okay, so just like in the double dot, it's the distance that the asset moved between that support and resistance line would be then your target to retrace that movement to down here. So it is T equals S minus H. H is the height of the movement. The distance between the support and the resistance level. Okay, now with a triple bottom, it's exactly the opposite, flipped over in the opposite direction. So we have triple top, triple bottom, double top, double bottom. Most traders don't trade from the double tops, double bottoms. They will trade from the triple tops, triple bottoms. Most traders will trade from a head and shoulders pattern. It is very, very popular. It doesn't happen that often. When it does occur following the rules, it is quite reliable. Now we have to look at trends and breakouts. An important measure of the quality of a pattern is the trend that precedes it. It doesn't matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. So in other words, you're not just going to take this triangle or this wedge or this and drop it on a chart and say, oh, look at that. Because they form all the time. You have to look at what is happening on the charts moving up to it. So you want to see that there is a firm either uptrend or downtrend, okay, that it has been consistent in duration, and the initial trend partly determines the well-formedness of that triangle. You just don't want to drop odd and end zigzag lines on a chart. You don't want to just put numbers on a chart. You don't want to put dashes on a chart. You want to have some type of guidelines or rules. And there isn't a hard, fast set of rules I can give you. Okay. It is you taking this general guides and then practicing with them and seeing where they develop. Okay. Now, the pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, okay, it is called a continuation pattern. In other words, if price is moving up and then it breaks out of a triangle or a wedge or going upward, it is called a continuation pattern because it's very strong, because the bulls are saying that we're in control of the market, and a price breaks up, the bulls have taken back, regained. They took a break, and that's why the market eased down to form the pattern, but the bulls were now back in control, or the exact opposite if price is breaking out. Okay. Now, you have strong breakouts and weak breakouts. If the price breaks out through the triangle and just a small little gap, it's considered a weak breakout. If it breaks out in a very strong price movement, so you can see here we have upward price movement. I'm sorry, let me get my marker back on here. We have price movement on an uptrend. This would have been the top of a triangle or say a channel, whichever pattern form, and price gaps up in a, and comes out. This is called a breakout, but it's also a very, very strong breakout. So you have to look at where price breaks out of that pattern that you're looking for. A weak breakout is not usually traded. We're only looking to make decisions based on a strong breakout. So again, this is up to you to locate and start to look and be able to start personally. Otherwise, there would be so many rules that you couldn't even keep track of them. You have to get so you can recognize these and understand them by your own volition. You have to be able to see what is happening. Okay. If I just gave you a whole list of rules, you'd have all your walls covered with rules, and you'd be running around trying to find, oh, what is that rule that I got to apply here? You've got to be able to see the pattern, understand what's happening in the market, and then know what to expect. So as you can see on here, we have the falling wedge, we have the bullish rectangle, we have the bullish pennant or the wedge, we have the rising wedge, we have a bearish rectangle, we have a bearish pennant, and it goes on forever. Now, if you notice, they're pretty well common. A falling wedge, you would put your stop down here, you put your entry point when it broke out, and you would set your target point for an equal distance of the height of the wedge. Okay. A bullish rectangle, you would put your stop right below your support line. You would enter it when it broke out above your resistance line, and you would set your target for the equal height distance of the support and resistance line. Okay. A bullish pennant. Again, we see it breaking out and coming together here. Okay. In this case, it broke out upward. We would enter the markets when it broke above this resistance line. We put our stop loss at the bottom of the resistance line, and we would set our target for an equidistance of the height of the movement. A rising wedge, same thing. We would put our entry point when it broke out below the wedge or the support line, put our stop loss above where the wedge was forming, and our target price is the distance of the movement. Okay. So it's recognizing the movement and knowing what it's going to do and where to put your entry and exit points. Okay, now we have the different trend patterns that could happen. Okay, so what is a pattern? A pattern is a series of data that repeats in a recognizable way. It can be identified in the history of an asset being evaluated or other assets with similar characteristics. Patterns often include the study of volume as well as price. Patterns can occur within a downward or an upward trend or as marking the beginning of a new trend. There are bottoming and topping and continuation patterns. There's a follow-through day pattern is used in some analysts to identify market bottoms. The head and shoulders topping pattern is popular among day and swing traders. Continuation patterns include the cup with handles, the flat base, and the 3-week type. These are all kinds of weird names that are based on somebody coming up with something and their trading system. Doesn't mean that you need to trade them, doesn't it? You're going to hear about all of them. We've talked about the ones that are the market acceptable ones. Otherwise, you'll see some guru out there pushing his system with, I saw a new one the other day, flying saucers. Okay, and this is his system he's teaching you. But you have to be able to recognize continuation is when price breaks out and continues in the direction of the trend, the prior trend. When you have a reversal, it's when price breaks out in the opposite direction of the existing or the previous trend. So this is why you need to look at them. Now, trend patterns and chart patterns work extremely well with Fibonacci patterns. Fibonacci retracements are a great secondary indicator to add on to your charts so that when you see the pattern, the Fibonacci retracement pattern will help you determine what levels that you can expect price action and reaction. If you don't understand exactly what Fibonacci patterns are, we have a whole class, we have a 2-week class coming up actually in Fibonacci retracement levels. And they're very easy, but no pattern works again alone. So combining this with Fibonacci retracements, they're often used as part of a trend trading strategy. In this scenario, traders observe the retracement taking place within a trend and try to make low-risk entries in the direction of the initial trend using Fibonacci levels. Simply put, traders using this strategy anticipate that price has a high probability of bouncing from the Fibonacci levels back to the direction of the initial trend. So make sure you locate this on our schedule and come to our class, our 2-week class on Fibonacci patterns. And you'll see how we can then apply the initial move to the retracement and the subsequent move when the patterns develop themselves. And we'll take a look at looking at retracements, because Fibonacci's help when these patterns develop predict exactly where the retracement should be and tell you what price levels that they should move to. Okay, and we'll talk about how you recognize retracements and how you would then add these together with the Fibonacci levels to predict exactly what price levels you should see reactions to. Because as you know, Fibonacci was developed by a mathematician in the 17th century, and it uses 3 critical levels or 4 critical levels that are world renowned. The 50% retracement level is not, but it uses 61.8 and 38.2, and these combinations of numbers and a 21.8, a 21.6, these combinations are most likely to predict what the percentage of the movement will be, so that you can determine where to put your entry points, where to put your take profit points, and where to put your stop loss points. So combining trend patterns and Fibonacci and volume give you an entire trading system ready to start going out there and licking the markets. But you can't use any of these by themselves. You have to use them with other things, and that's why you can learn these trend patterns, but then you have to learn how to put them on a chart and how to read them to really understand where they will go. So thank you very much for joining us tonight, and hopefully I'll see you in some of our other classes, and we'll learn to recognize these chart patterns as we put on other indicators with them, and we'll see how falling wedges, rising wedges, triangles are seen on actual charts and then can be incorporated into your trading strategy. Thank you very much, and have a great trading night. Good night now.